Hello, everyone. I'm Bill Urbanik, one of the founding partners of SecondHalf Coach Wealth Management, and welcome to another episode of Hot Coffee, Hot Topics. Today, we're here with one of our strategic partners, longtime strategic partner. We won't talk about how long, Bryan Kisiel of Kisiel and Associates. Thanks for being here today, Bryan.
Thank you, Bill. I appreciate the opportunity to participate in this great venue to help clients learn more about things that keep them up at night.
Well, that's the whole idea. As with Hot Coffee, Hot Topics, there's a lot of things on people's minds these days. Some we'll get into, some we won't today, that maybe some for another time. So make sure you're checking out all our episodes because there's a variety of topics and everyone is greatly different. Each one is definitely different. But today we're going to talk about some taxes. And that's what Bryan's expertise is. And I want to start off, Bryan, with tax season's right around the corner.
It is.
All right, busy time for you?
It is, yes.
Stressful time for you?
It is, yes.
Huh?
First,
You gain weight or lose weight during tax season?
yes.
Yeah, I thought you might say that. Well, I think there's some big topics tax-wise I kind of want to talk about with our viewers, but maybe start off with a couple simple things. The questions I get a lot. One is with regards to tax returns, and some people are concerned with how many years tax returns they should keep. Some people keep all of them because they just want to, and I don't necessarily think there's something wrong with that. What are your thoughts, and what is the rule as far as how many years you should keep?
Well, as a general rule, the statute of limitations the IRS has to audit your tax return is 3 years.
Okay.
So 3 years post-filing. So if you file on April 15th of 2024, they only have until April 15 of 2027 to audit and or assess additional tax on that return. That's also, more importantly, the deadline for you to file an additional refund if you found that for some reason you had additional withholding paid in or income was reported too high. The IRS only gives you 3 years to catch your mistake as well. Then as far as keeping returns, I have clients that keep them forever. I have every one of my returns for posterity.
Yeah.
But
Business owners tend to do that.
yes. And that's because there are some longer statutes for business owners that don't apply to individuals. So as a general rule, I recommend keeping 10 years worth of business records and 7 years worth of individual records.
Okay.
Beyond 7 years, you're pretty safe. Again, because of the statute of limitations for both federal and state. So that's generally our response to our clients when we get.
And I think that's a good recommendation because even though it may be longer than what's required by the IRS, other things may come up in your life where additional tax returns are needed. Whether maybe you're selling a business and they need maybe more years of revenue data in order to assess a value, or getting a loan and they want to see more years of income or something like that. So there's definitely reason to keep maybe more than 3.
Absolutely. And if you own rental property, you'll want to keep them longer to just to substantiate the deductions if you sell that rental property. So
I'm glad you brought that up because one of the other things that comes up a lot is selling your primary residence and whether you're going to owe taxes on that. Can you talk about that a little bit?
the rules and the exemptions are fairly generous. If you live in your primary residence for at least 2 of the last 5 previous years, then the sale is tax exempt up to $500,000. So say you bought your house for $100,000 in 1970, and you're selling it today for $500,000. Mm-hmm. Assuming no other costs and no improvements, that's not unrealistic. You should keep track of all your improvements over that time. But just for the sake of simplicity, you'll have a $400,000 gain because you bought it for $100,000, you sold it for $500,000. Mm-hmm. As long as you've lived in that home for 2 of the previous 5 years as your primary residence, that means you paid the utility bills, you got your mail there, your driver's license was registered there, then you're exempt from federal and state tax, and there's never any local tax with the exception of the realty transfer tax on the sale of your home. So that's another good reason to keep very meticulous records as you make improvements to your home, because say you have a situation where you're in a seller's market and you do exceed that $500,000 exclusion threshold, generally your improvements can help reduce
Sure.
and eliminate some potential tax.
Plus, tax laws could change.
Absolutely.
I mean, we'd like to think that this generous exemptions, as you called it, would not be altered or extinguished, but it is possible.
Sure. We've come to find out, especially in the last 10 years, that Congress has never found a tax it doesn't like. So, trying to eliminate these exceptions is something that's always been on the table.
That makes me think of my grandfather, who had a joke about taxes. He said, "I'm a proud American and I'm proud to pay taxes, but I'd be just as proud for half as much."
Absolutely.
I think we all probably feel that way.
Absolutely.
Yeah. You mentioned with selling a primary residence and it being included in that exemption. One thing that I find interesting is, say a married couple has their primary residence and maybe they have a vacation property or a cabin in the woods or something like that, which would be considered like an investment property or something.
Correct.
But what if husband had primary residence at one place and wife had the primary residence at the other? You can still file a joint tax return, right? Or not?
No, there's some complications with that.
Okay.
As there always are. There's gotchas.
Okay.
Because if you file jointly, the IRS considers you one taxpayer.
Okay.
So you can only get one exemption.
Okay.
So in those cases, we would recommend to the client that they actually file separately.
Okay.
Rather than file jointly. And then there's some reduction of the exemptions, because the $500,000 is for the married filing joint taxpayer. So
so from a tax perspective on income, it can be arranged to make it okay.
Yes.
But would that scenario also make that cabin in the woods a primary residence and therefore fall under the exemption of selling a house without a capital gains tax?
Well, the cabin in the woods, to be a primary residence, again, would have to be occupied more than 6 months out of the year, would have to be where you get your mail, where you're registered to vote, where your driver's license is registered.
Okay.
So the cabin in the woods is probably not as significant an investment as your
house. Yeah.
Your main property.
Yeah.
So you don't want to cut off your nose to spite your face.
You try to find a way around some things,
Yes.
but yeah, I guess they get you in the end no matter what.
Yeah, the IRS just came out with a public service announcement telling taxpayers to be careful they don't double dip.
Public service announcement.
Yes.
Okay. That they don't double dip.
Yes.
All right, we'll remember that. Let's talk about some bigger topics. Things affecting people all over the country. There's some big things happening. Let's start with some good things. 529 plans, which have always been a great benefit for parents, helping them save for college educations. They're pretty easygoing on some of their rules and stuff like that, but a new thing has come out recently where unused money can be converted to a Roth IRA. Can we talk a little bit about that?
Yes, the Secure Act took effect January 1st of this year.
Okay.
Secure Act 2.0 that was passed. And in that provision, it allows for a 529 plan to be converted into Roth IRA retirement savings for the beneficiary. So the student doesn't use all of their funds for education. Historically, you have two choices. You could transfer it to a sibling or another relative, a grandchild, and whatnot, and let that money continue to carry over.
Mm-hmm.
Or you could take the money, pay the penalty and the tax on the earnings on that account, and go on your merry way. But because of the Secure Act 2.0, there's now a third option. So those unused funds for the child that decided not to go to college or went to a trade school and it wasn't as expensive, or for whatever reason, those those funds up to $35,000 can be transferred into a Roth IRA. Now, the gotcha is that those funds can't be touched for 10 years, and they have to be the direct beneficiary of the 529.
Okay.
So,
I mean, that's a pretty significant, advancement in the 529, options, because oftentimes people have a balance left over. There are some people who worry about saving in 529 plans. What if my kid doesn't go to a school that accepts these funds? But now you can use it for K through 12 private education. That was one development. Now you can turn it into a Roth IRA. So it's really, over the years, become a much more flexible tool too, and one
Absolutely.
that doesn't make people feel like it's only like the college plan.
Exactly.
That can be the original intention, but it has other options if that doesn't work out.
That's correct, because up to $10,000 can be used for secondary education. So if your child decides they want to go to a private school, they have access to those funds.
Is that total or a year?
That's per year.
Okay.
The other benefit too is time value of money, because of the fact that you're able to save today for a potential retirement 40 or 50 years down the road. Those funds will grow exponentially over that time, and it gives the beneficiary, the child, a big leg up on their retirement savings.
Yeah. And in the 529, it's tax deferred growth, and only taxed if you use it for a non-qualified expense.
Correct.
But going to the Roth, now it's tax-free.
Correct.
So long as you wait 10 years and meet the other requirements of a Roth IRA.
That's correct. Yeah.
That is a big development. Bryan, another topic that comes up is required minimum distributions, also known as RMDs. There's been some changes with those too recently. That could benefit the owner of the retirement accounts these apply to. Could you talk a little bit about that?
Yes, the change this year is that RMDs are only required if you reach age 73 during calendar year 2024. So if you turn 73 prior, then you're already in your RMDs. If you turn 73 later, you can wait until you turn 73 to start your required minimum distributions. The IRS wants to get their pound of flesh, so that's why they're making you take money out of your retirement accounts, which, with the other rules that change with Secure Act 1.0 with regard to the inherited IRA distribution requirement of 10 years, it's not necessarily a bad thing to convert some of the retirement money into non-retirement money for tax planning purposes, not necessarily for the individual that owns the IRA, but for the beneficiaries that will ultimately inherit the IRA.
And it's also important to note that if you're already taking RMDs based on the previous rules, like say you're 72 and you've been taking since 70 and a half, you can't now pause until 73. You got to continue doing what you were doing. That this only applies to people who are just hitting this age, right?
That's absolutely correct.
All right, that's a big difference.
Yes.
There's also it's going to be moving up from 73 as well, correct?
Yes, it will move to 75, theoretically by, I believe, 2025.
Okay.
But we'll keep an eye on that because we still don't know what Congress is going to do this year and next year with tax law changes.
Okay. Thanks for that. Now, on to a hot button issue. Everyone always wants to talk about Social Security, the solvency of it, how long it's going to be around, all that type of stuff. But one big change is getting talked about a lot right now that could be a good thing.
Yes.
And with regards to Social Security, we're not used to hearing good news on Social Security. Now, this hasn't happened yet, but it's being talked about. Could you talk a little bit about what's going through Congress right now?
Yes, because one of the biggest frustrations that the majority of my retired clients vent to me about is the fact that they have to pay tax on the tax that they already paid tax on. So
imagine that.
Yes.
And we're not supposed to double dip.
No, we're not.
But maybe they can.
Yes, absolutely.
Maybe they
Do
do.
as I say, not as I do.
Right.
So the taxability of Social Security has been a bane and a hot button since 1984 when the change was enacted and created the tax on the benefit that the retirees receive. The change that is running through the House Ways and Means Committee right now, and what we're recommending to our retired clients is call your congressman and say, make this happen, is eliminating the taxability of Social Security. And it's, once again, the middle class that's in the crosshairs here, because if Social Security is your only taxable income, you're not paying tax on it, because there's a two-ledged cliff that taxability of Social Security drops off, or you fall over.
Right.
Under certain income levels, depending whether you're married filing jointly, married filing separately, or single, you pay tax on 50% of your Social Security, and then as your income grows, that cliff becomes 85%.
Okay.
So as your income grows, you pay tax on more of your Social Security. The maximum social amount of benefit you pay tax on is 85%.
Okay.
But that's the majority of the middle class clients that are
Right.
at 85%.
And they're always the target, because even like you mentioned, if you only collect Social Security, you probably fall in a range that you're not going to have to worry about tax no matter what.
Absolutely.
But the wealthy, the upper class, so they're talked about a lot, aren't probably, even though they've earned their Social Security and should be getting it, they're really not dependent upon it, probably.
Correct.
So whether it's taxed or not, maybe isn't so much a life changer or really make that big of an impactful difference.
Right.
But when you're talking about the middle class and upper middle class, that's a big deal.
Sure. In the $80,000 to $150,000 income clients, that's a big deal.
Yeah.
For the wealthier clients, again,
Yeah.
it's a drop in the bucket, because
Mhm.
they're already paying tax at the highest levels anyway, and Social Security doesn't add that significant of a burden to their tax liability. But to the middle class, it could add 10% to your tax bill.
Now, it's important to mention that, like as Bryan stated, this is being talked about in committee. It's in Ways and Means right now, which means it's quite a bit of distance from actually becoming real. A lot has to happen yet. But like he said, one of the things that has to happen is it has to get support, and it has to be a priority for the people that are elected to represent us, so we're told. So call your congressman and make sure that they know that this is important to you, so that it can become important to them. And hopefully this moves out of Ways and Means and makes its way to the Oval Office someday, where someone's signing it and handing out pens.
Yes, absolutely.
Yeah.
At a minimum, we're looking at 2 years, but I mean, it's better to get it now
Yeah.
than wait another 2 years and see that benefit happen 2 years down the road. So,
one last thing I'd like to talk about is another big thing that is going to be happening soon, and it's starting to get a lot of buzz, especially with it being a presidential election year. You're starting to hear some talk about this, is the sunsetting of the Tax Cut and Jobs Acts that were passed under President Trump in 2017. Those are going to be sunsetting, which means ending soon. And what are our people in charge at that time going to do, and how does that impact people? You want to talk a little bit about that?
certainly. And that's going to be a big planning topic for this year, because these rules, the TCJA that was passed in 2017 that reduced tax rates, reduced tax brackets, and also provided for several other provisions, will sunset on December 31st, 2025 if Congress doesn't act. Congress hasn't even started talking about it, so it's still a little bit down the road. And with this being a presidential election year, this is probably not going to be a topic in 2024. It'll probably be a 2025 topic. But by then, we need to already be planning for the worst case and hoping for the best case, which is that Congress extends these provisions. But essentially, there's some big changes. The most significant is the top tax rate goes from 37 to 39.6, as it was in 2017. But what it does at the lower levels is it increases the tax rates at each of the lower tiers as well,
Mm-hmm.
and also compresses the tiers. So
Mm-hmm.
more income is going to be taxed at higher rates under the 2017 tax law that this replaced. So everybody's tax bill is going to go up
Mm-hmm.
on January 1st, 2026 if nothing is done.
Standard deduction would go back down.
Standard deduction will go back down from the 24,000 plus,
Mhm.
depending on circumstances, back down to 12. The number of household dependents you have will come into play again, because now you'll have the dependent exemption that you'll have to use to replace the 12,000 that you're going to be losing in the standard deduction. Child tax credits going back down from 2,000 to 1,000. Also, one good thing, and one thing I think needs to have happen, is miscellaneous itemized deductions for business owners was taken away as part of this, and also state and local and real estate taxes was capped at 10,000 under this. And if both of those sunset, I think a lot of people would be happy.
Yes.
In addition to that, from a business perspective, we talked about child tax credit. Well, even from a personal perspective, we had about 10% of our clients subject to alternative minimum tax, which is a calculation that says if you earn X, you have to pay at least this much in tax. And so that's going to revert back to the 2017 levels as well, which is a lot lower than where it is now. So we're going to start to see clients again jumping into the alternative minimum tax region and paying, again, a little bit more tax than they're paying right now. From a business perspective, a lot of our small business clients were able to take advantage of the qualified business income deduction, which was essentially a 20% of your profit deduction before tax. That will go away.
Okay.
So that 20% was generally used by our clients to invest in their human capital, so being able to retain staff, acquire staff.
Make incomes go up, create jobs.
Absolutely. All good
kind
things.
of good things.
Yes, absolutely. So those are the big things.
I see that something like that is probably most likely not going to be addressed, and it's going to probably hit close or actually expire, and if there's going to be leverage, it's going to become very political, like the expiration of the Bush tax cuts in 2010.
Absolutely.
They didn't act until they had to, and every side was leveraging every strength they had, and we'll probably see a big circus over that again.
Absolutely.
I would imagine. So
Yes.
we'll have to keep our eye on that, and rest assured, I know Bryan will, and from our position we will as well, on how that impacts our clients too. The last thing I want to say is I want to thank again Bryan for being here today. The wealth of information. I also want to stress the importance, the difference between a tax preparer and a tax planner. Tax preparer tells you a few things. They tell you how much you owe the IRS, how much you owe them, and see you next year. Where a tax planner works with you throughout the year to make sure you're making the right choices, doing the right things, documenting things the right way, to minimize the amount of taxes you pay, and make sure that everything is legitimate as possible. And I want to stress how over the years I've become personally grateful for Bryan's expertise, and I know many clients have as well. So again, thank you for being here. We value this relationship very much, and I know a lot of clients do too. So thanks again.
Thank you, Bill.
All right. Thanks you, everybody.